So what are the
Yeah,
dynamics around not getting ROFR'd or getting ROFR'd?
sure. And just so you're aware, my future yacht, I plan on making the name No Rofer. So I love this topic, and I say that all the time. So we're banking on that. And actually, I was working at Facebook at the time as a very junior level employee. I dropped out of college to go work at Facebook when I was 19.
Oh, wow.
Um, I was at Facebook in 2010, 2011, 2012. So I saw it through the IPO, but I was very junior. I certainly wasn't focused on secondary transactions at the time. But colleagues around me were getting approached by random investors on the street saying, I want to invest in Facebook. I want to invest in Facebook. And back then, it was definitely a very small club of venture capital investors who had insight and ability to sit on Facebook's cap table.
Hello, and welcome to Fireside with a VC. My name is Andrew Romans, and I'm actually thrilled to have Andrea Lamari on the pod. Andrea is a general partner now running the San Francisco office of Manhattan Venture Partners, MVP. Very slick acronym there. She is focused on secondaries. And so we're really going to get into on this pod kind of a 101 tutorial of understanding secondaries. So this is people buying and selling of shares of a privately held company without it being a primary where the money goes to working capital to grow the business. It's literally VCs, angels, founders, even employees selling equity in their stay private forever, companies. So very interesting front door, back door way of getting into the marketplace. I think MVP is very well positioned as primary and secondary to win in this space. And they are lucky to have gotten Andrea on their team because she's the founder of Equidate, which is another really cool name. I love Equidate. It's like equity, liquidate, which then changed the name to Forge, which is listed now at this point. And you were at Growth Technology Partners. Actually, David Weisberg actually raised money for my funds early on. So he was raising LP money. We got the chairman of one of the coolest big banks, who's like an elder guy who's smart and experienced and controls a humongous bank. And so we're very thankful to those guys for getting LPs that are still with us today. So we could talk a lot about secondaries, but I want to get into the weeds of it. And then where we are in today, we're in a very interesting bid-ask moment in history. We're actually recording this in mid to late February 2023, where you had a lot of companies, including my portfolio companies, raised huge 100 million plus rounds at frothy valuations in the summer of 2021. The market started to correct, and then Putin's invasion to me was like a 9/11 event that crashed the public markets. And so we're in a very interesting place of structured deals, secondaries, primaries. So we're going to get into all that from a woman who's got a front row seat negotiating these things. So, but first, a quick word from my buddy, Mark.
Hi, everybody. This is Mark DiTargiani. I'm with Pacific Western Bank, and we are a bank focused on helping startups grow and get to the next stage. We've been working with Andrew and 7BC for years now. Andrew and I go back a decade and a half at this point, and I've always respected the fact that he's a thought leader in the space and somebody that you can learn an awful lot. And he kind of opens up that window a little bit into VC and what's happening in the back room. So we're excited to be partnering with Andrew on his podcast here at Pacific Western Bank. We focus on helping startups get to the next level. We offer a startup services program for companies that are the pre-A, which includes some free banking and some high yield interest rates. And then when companies raise an A round, then we start moving into treasury management services and then venture debt. And we believe that we're one of the leaders in the venture debt market because we are flexible and we can do custom packages and we don't just do off the shelf type of term sheets. So enjoy the podcast. It's going to be a lot of fun. You're going to learn some things and we'll see you on the other side.
Hey, so Andrea, thank you so much for coming on the podcast.
Thanks so much for having me, Andrew. I am so excited to obviously spend some time with one of the kings of venture capital.
Oh, you're far too kind. And actually, if those are listening, anybody who can be into New York City, although Andrea is running the San Francisco office, you're coming back to Manhattan Venture Partners HQ. And March 7th, we're going to have a VC panel. So you can meet Andrea in person, and hopefully she'll stick around for 2 hours of networking and drinks and food that evening, Midtown. So Andrea, maybe give us a quick word on your background. You're really uniquely qualified to be operating in the secondary community. And I love the fact that you understand the perspective of a founder and even your own employees with maybe even some compassion about it. But, maybe explain a quick about your background, and then we'll help people understand what a secondary is and how they even work.
Sure, Andrew. So, my background is that about 15 years ago, when Silicon Valley was really getting the offset of the 2008 financial crisis back in flow, and there were companies that were really taking the dive into becoming much larger venture-backed organizations than they had seen in the late 1900s, aka the late 1990s, which is so funny to say these days, but I like to say it, which are companies like Facebook, Twitter, and the like, who were getting hundreds of employees, if not thousands of employees, gearing up for big IPOs going into the early 2010s. With all of that said, there was a rush of capital trying to invest in these companies, while there were shareholders and employees that were looking to sell a portion of their stock. And what I and a team of my friends all built at the onset of my career was a company called Forge Global. As Andrew, you mentioned, it was initially named Equidate, which is a combination of equity and liquidate, which is amazing that you made that that comparison and knowing it. When we built Forge Global, we took some initial checks from the Y Combinator network and amazing early stage investors as well, like the Bannister family. And furthermore, we had Tim Draper as support initially in Forge Global as well. So with all of that said, we wanted to build one of the few marketplaces for startup stocks so that employees and investors can effectively trade, theoretically, their stock or sell a portion of it before an IPO. Built that company.
Do you know Adam Draper, before he had Boost, had Expert Financial? Are you aware of this? And I used to live around the corner from them, and so he went. It was interesting because Shares Post, because you were kind of at the thing that I was telling Adam, hey man, if you wait to get your own broker dealer, it's going to take too long. And he goes, oh, they tell us it's only going to be 12 months. I'm like, trust me, they're so confused about what you're doing. That's going to be maybe never. Get under somebody else's BD and pay them your 10% and just get going. Shares Post said, to hell with the law. We're just going to get going. And then all the wind got in their sails. And by the time they got that BD of their own, it was time to move on. And thank God he did Boost, which got into Coinbase, and he's, carrying on the Draper legacy. So they know a lot. That family knows a lot about this space.
They really do. And to this day, Tim Draper's still in my orbit, and he still very much so cares about democratizing this space and investing heavily into it. So I love to see that momentum growing as the secondary market continues to unfold in this new generation. So from Forge Global, I actually took a step back because, quite frankly, my founders and I, we were in our early 20s, we were super green. And what I kind of humbly thought for myself was, as a way to become a real expert in trading and exchange technology, which is where the future of Forge Global was headed, I actually decided to step back as founder. And I ended up meeting the president and now one of the executive chairmen of the board of NASDAQ, the stock exchange. And what they positioned for me was to come over to the NASDAQ and help lead a new team that would be focused, on this private to public transition for startups and helping them with liquidity and other needs leading up to an IPO on the NASDAQ. And so I actually accepted a role to be one of the leaders of their San Francisco office at the NASDAQ Stock Exchange, which then rolled out a division called NASDAQ Private Market, which still exists in a subset of the same original format today. And at NASDAQ Private Market, we were doing really scaled big secondary and liquidity transactions for private companies like Uber, Airbnb, and the like. And so I was there for a few years
Was that the Sven Weber and SharePost was kind of in a partnership or something? I was confused about, was that an acquisition or the relationship with SharePost?
That was an acquisition of partial SharesPost assets. It wasn't the full SharesPost brand. Obviously, things like the Shares Post 100 fund lived on independently of the rest of the Shares Post organization. But what we did at NASDAQ was we did acquire some of their technology, some of their licensing and other assets. What we did also do at the NASDAQ while I was there was we acquired Second Market in full.
Oh, Barry Silbert. Barry Silbert,
yes,
Second Market.
Yeah. So we acquired Second Market in 2015. And Barry at that time had gone off to say that he was going to build the digital currency group, which obviously is a behemoth in the crypto landscape today.
He was Bitcoin crazy by 2009. Yeah. I mean, lucky him.
Yeah, I always give Barry Silbert credit because though he and I haven't spent any time together, but I know a lot of folks in his organization, he always had the foresight 5 to 10 years in the future to say what are going to be the next innovations that are going to disrupt the traditional financial markets. He had it with Second Market, he had it now with DCG, and I give him all that credit to see what he's been able to scale for the last 15 years. So while at NASDAQ, we unleashed a variety of products because now we had, partial Shares Post under our brand, as well as the Second Market organization. And I saw that really spin up and grow. I then made the leap to Carta, which usually, I should say in the past, not even usually, but historically was branded as eShares.
eShares, yeah.
eShares. So what Carta does best and is the ultimate Trojan horse is it offers a equity management solution for startups and investors to manage the equity issuances, the stock certificates, the cap tables of startups, all the way, from seed stage through, generally up to the IPO. And I went over there to help build Carta's private company stock exchange to run the same function, which is provide liquidity for all the Carta startup customers. So, I was there for a few years to build that out alongside Henry Ward, the CEO, and a phenomenal team. And that company is now valued at roughly $7 billion in their last private market funding round. And in today's landscape, I am now a general partner at Manhattan Venture Partners, which is a team that we have just over $1 billion under management. We've invested in 50 companies like Airbnb, Lyft, Palantir, Klarna, Epic Games, Udemy, and a bunch of other high flyer names. And where we predominantly focus is, you probably can guess it, but the secondary market, where our thesis of our venture fund is to look into the landscape of these late stage private companies and then really take an advisory level relationship with the companies that are in our portfolio to help them determine the tax, audit, and valuation impacts of doing secondary market transactions at scale. So that's where I spend a lot of my time is in with those portfolio companies, getting those set up and getting them ready to consider what the next 3 to 4 years would look like for their shareholder base to use private market liquidity as a function of recruitment and retention of their employee base.
Okay, so I just want to dumb things down a little bit so that anybody listening to this or watching this would understand that, explain the difference between a primary investment and a secondary.
Sure. So a primary investment in a private company, right? So we're talking about typically venture-backed private companies specifically, is that a primary issuance is when a company issues a new series of stock as a function of a private market round of funding. So if a company, a startup goes out to raise a series A, B, C, D, they are typically creating a new stock issuance to then issue to the investors who participate in the round of funding. And that's considered a primary. Now, a secondary is a transaction or investment in which existing shareholders, whether it's employees who hold actual stock or investors of a startup, they're actually selling their stock to investors. And that's considered a secondary. The company is not the one issuing the stock in that second example, right? These are transactions that involve existing shareholders who are selling their stock to external investors who are new investors typically. And that is considered a secondary. So primary comes from the company, secondary comes from shareholders.
Yeah, so we're talking not the publicly traded, listed on the stock exchange companies where, existing shareholders are buying and selling from each other through the exchange, but we're talking about a preferred shareholder that's an investor that put cash into the company as a primary, who's now selling the shares. So the money goes into their pocket to go off and buy a car, or do something with it, not working capital primary into the company. Great. And so I want to talk like kind of the boring 101 stuff first, and then get into the dirty conflicts of interest and intricacies of how these things actually work. But who are, so just, we kind of covered this already, but who are the sellers in secondaries? And it's interesting that you guys are really trailblazing into employee liquidity programs. But, you know, in the ancient times that I was really active in the secondary market, you were kind of dealing with the founders and the preferred shareholders.
Yeah. So, you know, with our data MVP and where we see the composition of what is the segment of these sellers, right? Currently and historically, it's been trending in a similar kind of direction, which has been around 60% of the time, you're going to see that a seller in these transactions is an existing investor of the company. And typically, it's an investor who's considered an early investor in the startup who has perhaps seed, Series A, Series B stock, and they're now looking to make a return their funds, get actual real gains versus paper gains on their investment. And so they're typically the ones that are considered these sellers. Now, 40% of the time, you can consider that the sellers are founders and employees of the startups who have a lot of their net worth tied into the startup stock, and they just, you know, they want some diversification. They're looking to pay for some sort of life event, whether they're getting married, buy a house, you name it. And now they're saying, hey, listen, I really can't wait for a formal IPO or exit in the form of like an M&A event or an acquisition, right? What they're looking to do is just get some level of cash in their bank account so they can go diversify. So that's who the composition is.
Yeah, and for anyone who's kind of like a civilian listening to this, imagine that you are a founder of a company that you raise money from me, so like 7BC at an $8 to $12 million valuation, and you went from owning 50% of the company with your co-founder, you know, to owning 40%, and then you go through a few more funding rounds, and now on paper you're worth $300 million, like Austin Powers numbers, and yet all your HBS buddies or all your Stanford buddies are buying cabins in Lake Tahoe, and actually paying for skis and a lift ticket is looking tough for your kids, you know, and like living in San Francisco, living in New York City, you know, Austin, Texas is getting expensive as well. That, you know, there's only so much you can pay yourself in cash, and yet you're worth all this money on paper. Talk a bit. So it makes sense. Talk a little bit about, you know, what happened with the dot-com crash, Sarbanes-Oxley. Like, it used to be in the ancient times of the 90s, your market cap was like $350 million after an IPO on the NASDAQ. That was considered, you're in the winner circle. Where, you know, so explain the stay private forever phenomenon.
Yeah, I mean, I will say the following too. You know, if we look at the late 90s, where there was a big ramp up of IPOs and a rush to the IPO market in a very short duration of a company's life cycle. So, you know, companies in the late 90s were getting positioned by bankers and just the hotness of the market to say, hey, you know, you've been in business 2 years. Let's ramp up that valuation, take you public, and see where the high flying numbers can go. Because the stock market was where you could park your company to generate a ton of capital and investor momentum. There just weren't as many venture funds back then in operation as there are today, where the venture dollars weren't as freely flowing to startups in the late 90s. And so companies would rush to IPO, see a big run up of the stock, and then obviously when we went into 2000, 2001, and saw things crash and come down. I think the big difference we see between the 90s and, you know, kind of fast forward to 2008 going forward is really that startups in the late 90s who were successful, they went public really early. And many of those employees and early shareholders, they didn't have that much stock at that point, because the startups were like 2, 3, 4 years old and going public at that point. So people were barely vested into their stock like there wasn't this big kind of market to sell the stock. People, were just going public immediately, which is great. So they sold their stock into the open stock exchange, open market. Fast forward to, post 2008, and you suddenly had a subset of companies where they started, staying private longer than they were in the late 90s. Their employees were realizing that they were getting approached by investors. I mean, Andrew, you probably remember this. In the Facebook era of hotness, of momentum, which is like, when they really were picking up as an organization. And actually, I was working at Facebook at the time as a very junior level employee. I dropped out of college to go work at Facebook when I was 19.
Oh, wow.
Yeah. The whole thing. I was at Facebook in 2010, 2011, 2012. So I saw it through the IPO, but I was very junior. I certainly wasn't focused on secondary transactions at the time. But colleagues around me were getting approached by random investors on the street saying, I want to invest in Facebook. I want to invest in Facebook. And back then, it was definitely a very small club of venture capital investors who had insight and ability to sit on Facebook's cap table. And it was otherwise very closed off to the normal, regular retail investor in a variety of ways. What ended up being born out of Facebook in that era Sarbanes-Oxley had come out, but let's just talk a little bit about this, which is the Jobs Act was being formed. And in the Jobs Act of 2012, you had Section 2, Title 2 of the Jobs Act, which increased the shareholder limit for startups from 500 to 2,000.
But Facebook was still violating that, right? I mean, they had to go public because they were in violation of that.
They were violating that, but it was because of secondary transactions, actually.
Yeah.
So that was a big impetus for Title II of the Jobs Act. And actually, the team at Second Market was very pivotal to writing Title II, which is that shareholder limit increase because of this. But they totally violated it. You're totally right.
And Barry Silbert was doing it. He was doing it before and after lunch. They were just doing Facebook, at the time. I think it's worth noting that, like, you've got these, like, Pinterest, Instagram, Klarna type Spotify's, where every non-Silicon Valley person in the middle of Chicago is trading and creating SPVs to buy off of someone else in Chicago who bought off of somebody else in Chicago that's never met Elon Musk, and they've got SpaceX and Tesla logos on their websites. And we were operating in the secondary market of the non-phenomenon that's below that radar, where you have these issues of we're in a stay private forever situation. The actual practice of the secondary market has even further elongated the path to liquidity for the company. So why should I could say the names of some of our founders. Why should she IPO if she just took 40 million cash off the table on a secondary during or right after, if she's really smart, the last $100 million funding round? And so she never wants to go public. And me as the seed investor in that, or Series A guys, we're like, damn it, when are we going to be returning actual cash to our LPs? Which makes us think, I'm glad there's like legit players like MVP that we can talk to about buying even 5% or 10% of what our fund owns in that one company, so I can return the money to LPs and let them spend it or let them re-up in the next fund. So there's a mix of you're underpaid employee, your buddies that are lawyers at Wilson Sonsini or investment bankers are buying houses in Tahoe. You're literally talking to your spouse about the lift ticket. And yet you've got all this Austin Power money on paper. So it totally makes sense for some founders to get some liquidity, and it totally makes, and even diversify. You've got all your eggs in one basket. Believe me, your VC is diversified. You are not if you're 100% concentrated with all your parts in that one basket, So that makes sense. Talk a little bit about, often, the VC and the founders, when you're negotiating that kind of Series A or late seed, which will be a priced round, and they finally drop the ESOP, which further wipes out the conversion of the seed investors. When the ESOP is the employee stock option pool, right? It's not the employees that are sitting at the table negotiating for their union rights. It's literally the founders and the investors that discuss it. And everyone's got a hypothetical minimum 15% of the share of the pizza pie of the ownership of the company will be ESOP, but then it often gets squeezed between the founders and the negotiation. So, when you come in and talk about an employee-wide liquidity program where you're going to basically provide cash to provide liquidity to the employees who are largely not really at the negotiating table, on these. This is like a second wave of the evolution of the secondary market. What percentage of the company is in the ESOP? How much of it are you guys buying? How much of these, options, RSUs are vested? And then what are the best practice policies of like allowing an employee to sell some shares, or options?
Yeah. Oh yeah, and to me, this is so fun, right? Because this is the kind of thesis and kind of process you work through with a startup where it turns the startups really vulnerable. And let's just talk about that for a minute. So when we go in and work with companies, these are usually companies that are, about a Series D as in dog. They've been around 3, 4, 5 years at this point. They've got a couple hundred employees at minimum, and these employees are starting to really ask questions about when that eventual exit's going to happen. And, at the end of the day, the companies might not know. They might not have an immediate, imminent timing for the exit, but they certainly are getting asked these questions from the employee base. And, the reasons that we just described around why people seek liquidity when they go to work at a startup is because a lot of their net worth is tied up in that value of the startup. They're working day in, day out at the company. They're not, out there diversifying their portfolios because they're just heads down building a great rocket ship, right?
And also, let's just insert in this is happening in the context of a talent war, where if your employee gets a mild bullocking from their manager and goes out for lunch for a falafel, and they're in Soma, they'll see like a chalkboard saying, "We just raised 45 million from 8 VC. Come on in. We're hiring everybody." So good luck incentivizing this employee to stay at your startup. So I think that these liquidity programs tie into helping them understand what's my other 90% worth if we're going up and to the right and I can get cash out, now.
Yeah. Exactly. And see, so what you're just mentioning, Andrew, is spot on. Like the talent wars of Silicon Valley are violent, even though today there's obviously a different tenure being kind of discussed around whether employment is up or down. And obviously there was a massive run up in employment and hiring across the board during COVID. But even now, as we kind of look at these things, startups are up against not only other startups for amazing talent, but they're also up against the big public companies who issue employees stock options. And as soon as those employee stock options are vested, they can go sell them on a stock exchange. They can go log into their E-Trade account, Robinhood account, and sell some of that stock as soon as it vests. And so that is a really, really compelling argument for why to go work at a public company. Now, obviously, there are other indicators around public market volatility and what is that upside potential. But I'll go back to like the focus on these private companies and these kind of big employee liquidity programs. So with all that said, that vulnerability I was talking about is where things get really exciting for us. And it's because we sit down with these startups and they're well-funded, well-capitalized, they have a big balance sheet, and they say, listen, we need to recruit new talent and we need to retain the talent we have. We need to keep them incentivized and happy. We're happy to kind of structure something that lets our employee base and our greater shareholder base sell some of this stock. So with all that said, we work with the companies to kind of set up these selling parameters. And what does that mean? So really the company has full, jurisdiction to say, listen, we're going to run this program. It's going to be something like a month-long program, give or take. There's some flexibility in there that we can just talk about. But anyway, we set up the program. The employees can sell 10% of their vested stock, right, for example. Yep. And then maybe, the other parameter is that they have to have been with the company for 2 years or more, because then they've at least vested into the stock a little bit. So maybe what I'm talking about is that, for example, they might be able to sell 10% of their vested stock. They've been there for 2 years. I mean, at the end of the day, that's a very low portion of their relative all over stock compensation
Right.
package.
And for most people, like the vesting schedule for these employees is typically you got to work there for a year. So after 12 months, you've got the cliff, and then it vests every month. And it's typically 3 years or 4 years for an employee, longer for a founder. But so that means if you've been there for 2 years, you've vested either 2/3 or half of your initial grant, right? And then you're saying you can't sell more than 10% of that and then leave with your cash and start your own startup.
Exactly. And that, that 10% figure or the 2-year kind of duration of your tenure, like these are just variables that companies play with, and we model with them the impact of what that's going to mean around how many shares would ultimately be sold theoretically into these kind of programs, and all the variables that kind of go further into baking into the whole concept of it. So this is a process that hundreds of companies that honestly, Andrew, like when you were getting started, which obviously even predates me in this kind of secondary market space, it was very taboo to be such a proponent of this form of liquidity. Historically, back in the early 2010s, it was treated as like a dirty kind of back alley way for employees to kind of cash out of their stock and sell it to dentists and doctors, and it would, the company would get pissed off, quite frankly. But nowadays, companies are using it as a tool and as an HR mechanic to keep employees incentivized. So we set up these programs, and I will tell you, like, one of the coolest stories that's ever happened to me, just very humbly, I was at a bar in San Francisco on Fillmore Street, and someone came up to me and they said, hey, you were at my office, my startup's office. I think it was like Uber or Quora or like, one of those like kind of legacy 2015, 2016 startups. And they said, you were at my office, you gave a presentation, I worked there, I'm one of the employees. You launched the program to let us sell some of our stock. This woman that had approached me at the bar, she was like, I'm pregnant. My husband and I couldn't afford to decorate our baby's new bedroom, like the nursery. And, that extra $25,000 to $50,000 that I was able to get after that program, like, let us do the remodel, like, thank you so much. And she was crying and she was like, thank you for like teaching me how to do that. So, I mean, it really is an amazing tool if companies know how to do this and just take a step back and say, how do we set this up for now? And then maybe how can we repeat a program like this going forward, leading up to our IPO?
Okay. So I want to talk a little bit about, if you're dealing with the employee-wide liquidity program, then this is not going to come into play. But when I was in the secondary world, coming out of Founders Club, and I got under a BD helping like Palantir guys, and then a whole bunch of companies you've not heard of, like Sunrun and others, sell some shares. You had a right of first refusal that the, major investor rights gives you, like information rights, gives you a right to invest and maintain your ownership percentage in a pro rata. And then you got a right of first refusal. So like in Pinterest, you'd have all these kind of New York, Chicago people running around trying to raise money to buy shares off of a founder of Pinterest. And so not the, employees were not involved in the game back then. They were very underrepresented at the table. But like early investor, Brian Cohen was the first angel in there. And so Brian was like, hey, I want to buy myself a $15 million house in Southampton that I've been to, which is amazing. And he got that money out on a secondary of Pinterest. So what's interesting about the secondary market is, to me, also is how it happens. So like if you've got Brian Cohen, first angel in Pinterest, and then some secondary investor wants to buy shares, they agree on price and terms. Then there's the right of first refusal that the major investor rights include, that they can exercise their right of first refusal and buy it at the same price and terms, or they can waive their right of first refusal, their ROFR. And then
the company also has this ROFR as well. So either the company could repurchase the stock from that shareholder who wants to sell it, or they can assign the right of first refusal to a subset of investors who have that right. Exactly.
Right. So when I was involved, you really, and we don't do too much in secondaries. We're more of like, we should sell something to MVP, frankly. as early investors in companies that have, crazy big valuations that, we don't know when we're going to get out from an exit or lockup and all that. But how do you not get ROFR'd? So being ROFR'd means I agree with the seller, early investor, and whoever, and you can get ROFR'd by the company's treasury, or you can get ROFR'd by any investor. And how many days, like it's changing, like what you see in these agreements of how many days they have to waive the ROFR. So Ron Conway, with all of his Twitter money, would just send out a couple of emails or make some calls from his car and spin up an SPV and ROFR the hell out of that poor, miserable person who wasted all their time. And they're like, Ron's on the cap table. Let's just give him more. He's a good guy. So what are the dynamics around not getting ROFR'd or getting ROFR'd?
Sure. And just so you're aware, my future yacht, I plan on making the name No ROFR. So I love this topic. And I say that all the time. So we're banking on that.
By the way, while we're on that topic, do you know what happened to Brian Cohen's yacht? Do you know this story?
No.
He built like a Jim Clark.
And do we want to talk about who Brian Cohen is?
Oh, sorry. Brian Cohen is the former chairman of New York Angels. And now he's got New York Venture Partners, NYVP, with his son Trace. They're both awesome. I love these guys. And he, with his Pinterest money and other good exits he had, he sold a PR business that made him a kind of prolific, his own money angel, 2-3 investments a week, all New York City. So he was in everything. So he was in Pinterest. He has this huge catamaran, and it somehow sank to the bottom of the Atlantic Ocean. I love bringing this up. He loves talking about it too. Not really. But anyway, he's a great guy.
I hope he's got the good insurance on that one. I'm sure. But no, that's wild. That's super wild. So when I get to Brian Cohen's level, I hope I do not have a similar story, but it'll be funny nonetheless that my boat will be called No ROFR. But anyway, on this concept, what you're talking about right now, to kind of switch gears, those programs that I talked about that you and I, these companies are setting up, whatever, these are seamless because we pre-clear the ROFR with the board of directors of the startups. So like,
exactly, yeah.
There's no issue with the ROFR. We've already covered that way in advance of setting up one of these programs. What you're talking about is when shareholders of companies want to do a secondary transaction, and it is a one-to-one transaction typically. And I say that meaning it is a shareholder who has identified a buyer in the form of some type of investor to buy their shares, and they want to go through with a secondary transaction, right? So they've got some stock, they're a little nervous, they're like, hey, I don't want to piss the company off, but I really want to sell my stock. They find an investor through a multitude of channels, whether it's brokers, network, whatever you call it, and now they want to go sell some of that stock pre-IPO and do a secondary. You're talking about this concept of the right of first refusal, which is in 99% of the shareholder agreements that exist in venture-backed private companies, which is effectively the process of how to do a secondary transaction. It's outlined right in the documents in that right of first refusal clause. So, you're talking about how to get around it, how to do it. Now, the selling shareholder in this transaction, quite frankly, it doesn't really matter ultimately who their counterparty is, because they're still going to sell their stock at the same price and the same amount of stock no matter what, because that's how the ROFR provision works. But if you are an investor and you're trying to get into one of these transactions, be that counterparty that's buying the stock from the selling shareholder, how do you do that? How do you navigate it? How do you make sure it's worth your time and your capital to even go forward with it? Well, I will say the following. The way to do this and do it effectively, if at all possible, is you're asking that selling shareholder to preempt that discussion around the transaction. And what do I mean by that? You as an investor counterparty, this is just kind of inexperience and what I've seen be effective to get through this.
You're being very humble. This is how you do it. Keep going.
So you're talking, that selling shareholder, you have to imagine, like I said, they're a little nervous. They don't want to piss the company off. They're not trying to signal that they're trying to get off the cap table and I don't believe in you as a company and whatever. So the best way to kind of think about doing it is having that shareholder speak to someone on the legal or finance team of the company and say, hey, listen, I'm just trying to be respectful here. I know, I've read my own shareholder agreements. I want to sell some of my stock. I'm just giving you as the finance or legal department, or, you know, better yet, talk to the CEO or C-suite about it as well. But quite frankly, a lot of this activity sits within the finance or legal departments, and say I'm trying to sell some of my stock. I've found an investor. We're going to go through with the right of first refusal process, sell from my stock. Well, the best thing outside of just kind of posing that as a question or maybe a comment or statement, depending on, you know, how bold you want to be as a shareholder, is telling, you know, asking the finance legal department, the CEO, you know, hey, listen, this counterparty, I think it's a strong counterparty. They're going to be a good addition to the cap table.
Yeah.
What can we do to keep in mind how to ensure that this actually clears the right of first refusal process and the investor is not blocked along the way because you as the company exercise the ROFR, or you guys assign it to someone like a Ron Conway, who's just going to sit back and collect shares of the company and just rack that up. Like, how do we let this guy or gal join the party and actually buy my stock? And you know what? Usually in my experience, the finance or legal teams will be upfront about it and say, hey, listen, for you to get this done, or for that the investor to get it done, you have to price it at a certain level. You have to buy a certain minimum or maximum amount of stock, and maybe you have to time it around something in the upcoming future, because maybe there's going to be a big round of funding, a new valuation is going to get set, and like that timing, the size, and other dynamics around even just navigating discussions with the board of directors are things that the buying investor counterparty can keep in mind, because sometimes it even takes just having you as an investor, maybe you check out who's on the board of directors is another example, and saying, hey, I'm buddies with this person at Sequoia, they sit on the board. I'm going to call them up and say,
Yeah.
hey, friend at Sequoia, can you make sure not to exercise the ROFR here? Like, this is me. I'm coming in.
Good luck.
In
Good luck. Good luck getting that from Sequoia. If anything, Sequoia will invest in our startups and say, you're going to rip up your right of your pro ratas. Like, I legally have a right to invest alongside Sequoia, and Sequoia says, we get 100% of this round, or else it's not going to happen. And then everyone's like, let him elbow us out, and there's this evil practice. Yeah, I think to some extent, you've got to be a 1 billion AUM MVP or W Capital or Industry Ventures. That, like, industry is, they're investing in the funds, saying, if you ROFR me, I won't re-up in your next vintage. That's great. You know, that's putting like nobody ROFR me on the back of your yacht, right? I mean, whereas, you know, I don't think W is doing that. It's just a little harder, but at least you can say we have the ability to participate in the primaries, or we're big and we have a good reputation. We're not dead weight. We can add value. But you've got to be an insider. I think that the days of like being from Chicago, I mean, no offense to Chicago, but like to not be a Silicon Valley insider and be able to navigate all of these strange riptide of currents and not get badly ROFR'd is tough. So Andrea, changing gears for a second, I want to talk about where we are in the market. So, you know, for people that are not right in the active buying and selling in the primary side, what we witnessed was a little shock of March, April 2020 with COVID. And then it was like things went bonkers. Everyone's digitizing, everyone's buying, taking meetings as a priority on how to digitize now that I'm in my pajamas over Zoom. So we hit, I think, a peak of 2021 summer. And then by like August, it was cooling down. By September, October, we were getting into insane pre-money valuations, as opposed to we just would not participate in that summer 2021. We were happy to see our portfolio companies raise at those big valuations. But without saying the name of any of our portfolio companies, there was companies that raised at 2.5 billion, 1 billion, 500, 750 million pre-money valuations. And then if that would have been a very good time to be selling some of our fund shares or employer or anything. Now it was totally cooled down by October, November, December 2022. And then Putin invaded Ukraine, crypto, stock market crash. And you're there at like the pre-IPO, I would say a very dangerous part of the market, that if you're buying shares at a very high share price, these guys might go public at a lower share price when we're back down to, look, it was like 47x, of sales to valuation. And then it went, and it used to be 12, and now it's like 5.3 or 5.6, right? So where are we in a bid ask agreement or not agreement in late stage, whether it's primary or secondary?
Yeah, so it's a really interesting time to see this play out. I think generally, as you said, Andrew, it's like we were seeing companies, that kind of 47x forward multiple sales to revenue
But forward
concept
multiple,
was,
what nonsense that is. How about
yeah,
last 12 months or where we are now? Why not go 36 months forward looking? It's just stupid.
my favorite is forward multiples off of like future years revenue. So it was like forward multiples off of 2025 revenue was just a way to make it seem palatable to the investor pitch. So
Yeah, everybody does that. Everybody does that.
it's just wild. It's so wild. So yeah, I mean, it's crazy to say this, but in the COVID era, I even saw secondary market transactions where a company would raise a primary round of funding. They'd go out, raise their series D, E, F, for example. Immediately in the secondary market, the run-up of the stock value was that it would price 20 to 30% above that new round of primary. And this was during like the COVID era. And the reason that would happen was because shareholders would say, oh, well, we just raised a new primary and you, investor, couldn't get in, and now you want to buy my secondary. So because of that exclusivity premium and scarcity value, I now want a massive premium because you couldn't get into the round and I know how hot my stock is, so pay me a premium. That was happening.
Can we pause on this for a second? Because like when I was running the Founders Club as the equity exchange fund and doing secondaries, we were really focused on the founder. So we were not so much buying off of the preferred shareholders who's got a higher position in the liquidation stack, or it would be the angels that would be the sellers. We were dealing with big funds that were on Fund 12. They don't care about making distribution now and selling anything early. In fact, if they sell early, that might collapse their ability to return a $1.2 billion fund. So they were absolutely unincentivized to sell anything, whereas the angels and the founders, they were like hot damn for all those reasons. How do you, in your mind, price the difference between common shareholder, so like founder, and a preferred shareholder in a company that's raised 100 million of funding? Like, because again, if I'm the preferred shareholder, I probably, when the exit happens, let's say the company is sold for $200 million in an M&A transaction, they've raised 100 million with a 1x liquidation preference. The first 100 million of the exit consideration goes to the preferred shareholders, and of the remaining 100 million of exit consideration, that is pari passu divided of what percentage of the company you own. Now I'm jumping over participating and non-participating preferred, but or more than a 1x multiple. But how do you discount common versus preferred before we get into this? You got to pay what I'm asking for because you couldn't get in on the primary.
Yeah, so there are a few mechanics to kind of think about this, right? So preferred stock, as you're describing, is obviously more valuable, and quite frankly, when it's the most valuable is when things are going down and you're thinking about, God forbid, there's a bankruptcy happening and who's going to get paid back first. I mean, if you think about share classes, right? At the end of the day, any debt will get paid back first, any convertibles. Furthermore, you go down in the stack and it's going to be that last round of funding that gets paid back next. And obviously you're talking about liquidity preferences as well. So if there's a 2x, 3x, pari passu, all of this stuff matters when it comes to the share classes. And so with all of that said, you're thinking about the worst case scenario, which is a bankruptcy. And, times are scary right now. Things are volatile. Like, I don't necessarily think that there's going to be this massive wave of bankruptcies in the startup world. Maybe I'm a bullish, person by nature, but I think a lot of startups are a little bit not necessarily too big to fail, but they're too big to not be able to figure something out to get some sort of liquidity exit in some way, shape, or form.
Or sometimes the board's taken over, and you see it in biotech. Yeah. The company's raised 500 million. It's gone on far too long. and OrbiMed says, we're selling this for 550 million. I just want my 500 back. F the founders and F everybody. And that's where there's a huge discrepancy of preferred, top of the liquidation stack, or in it, and common, I get paid after that 500 gets paid out. You could have a carve out. You might have a carve out management incentive plan, but that's going to be like 10% of the exit.
And that's it. Exactly. Right. So with all that said, that's where, if you're thinking about these secondary transactions, how to price them, that preferred stock and where it sits in the stack, whether it's early preferred or junior preferred, meaning is it, it's series A, B, C kind of stock. And then the senior preferred, the late preferred is older in the cycle into the stack. So series D, E, F, G, whatever. So you're kind of thinking about, what am I buying, right? Am I buying early in the stack, late in the stack? Am I buying common stock? And, quite frankly, that preferred stock is usually pricing anywhere from, on average, if I look at like our data and just secondary market trends, preferred stock is usually priced in today's market. Now, this is, we're obviously February 2023, but a preferred stock class can take anywhere from a 5 to 15% premium above common stock and where it prices. Now, obviously, that's all on a relative basis. You've got to keep that in mind. Common stock these days is taking a 25 to 40% on average discount to the last round of preferred's share price.
Do you know historically common was 30. It used to just be. Now, I would go deep into examining the liquidation stack in great detail with scenario analysis of what could happen and what's going to happen. And if you IPO, right, everything converts into one class of shares, and goodbye preferences completely. But generally, rule of thumb, it was 30. And this was in the very early days of the secondary market. So it's fascinating to hear where it's gone to.
And I will say the following, though. See, I'm talking about averages today. This is where just, obviously this is my honest opinion as I serve the market, I wear my macro hat and all the best. The fact that it's not a deeper discount on average, if I'm looking at means, I truly think that there's still a world where we're going to see a bigger discount and shift here in general. I think right now there is still, as you said, this kind of bid-ask discrepancy where shareholders who are looking to sell their stock are still hanging on for hope and thinking that they can be asking for this, effective premium. Whereas, quite frankly, I see a world where somewhere like 40 to 60% discounts make a lot more sense for common stock relative to the last round of preferred share price. And so the fact that we're still kind of lingering to that 25 to 40% discount makes me think that there's still a wave of discounts that are going to be baked into the market pricing in the coming quarters. Again, that's, if I'm looking at this from a macro perspective, and the fact that I don't know if I necessarily have seen the complete startup valuation reset fully be baked into the overall market. And so I think that that's where today, in order to get a secondary transaction done, you have to really be doing what you said. You do waterfall analysis, sensitivity models, to the extent you can, to figure out what's going to happen in the worst case scenario if I'm buying this asset and then it goes public and I'm out of the money because it went public, at a bigger discount. Now, just before we move on to anything else, I want to stress this is what's happening and playing out right now is we're seeing these late stage pre-IPO companies suddenly get really humbled for the first time in a few years. We had companies, we saw high-flying companies, as of recently, Stripe, the payments processing fintech darling of Silicon Valley, who last raised a round of funding at $95 billion. In the secondary market, they were fetching a valuation of upwards of $120 billion on secondary transactions. And now the rumors are out there, it's getting published all over the news, that they're thinking about a much, much lower valuation that brings them down 45 to 50% lower than those $95 billion valuation highs. And these are now investors that are kind of going back to the drawing board and saying, I have to dollar cost average down, and how am I going to do that? And secondary transactions are absolutely a way to do that if a company is not thinking about raising a down round, which obviously that's what Stripe is contemplating.
Yeah. And this brings us into the topic that I really was hoping to get into. on structure. Explain what structure is at a high level, and I'd love to hear what's the craziest structuring weird deal you've ever seen.
Yeah, so oh, that's a fun one. So structuring. So these transactions can take a variety of structure. I have seen that, a plain vanilla, I'll call plain vanilla structure is if you own private, common stock, preferred stock outright in your name, and an investor's going to come and buy it out of their fund, or maybe it's an individual angel, high net worth, family office investor who's just going to buy it in their name, and it's just a one-to-one transaction in your name to someone else's name, investor to seller, right? That's
No
easy.
structure.
That's
No structure.
No structure. That's easy, right? That's just the plain vanilla stuff.
Yeah.
Now, things are getting a lot more funky these days, and I kind of love to see it because I'm a structure person myself. I like to be creative when you need to be, and obviously I'm a structure person who loves to see varieties of flavors of these secondary transactions happen to benefit all the counterparties involved. So benefiting the employees, benefiting the shareholders that are buying the stock, or the investors who want to buy the stock. And when it comes to structure, it's how do we get it done? How do we do it seamlessly? Who are we going to benefit in all of this? SPVs, or special purpose vehicles, as you described, Andrew, earlier in this, these are dedicated LLCs or investment vehicles that are being set up by investors to buy a single asset, typically, right? Single asset, special purpose, SPV. These are being set up to do a variety of things like co-investments, shell games to some extent, but all very kosher in many cases. It's not like the 90s anymore when we had Enron, who was the king and queens of shell games. But furthermore, if I'm kind of thinking about this, investors these days are being crafty because, quite frankly, SPVs make for an awesome way to collect management fees, carry, and AUM, and still have investors sit at the forefront of a relationship of an investment. And so SPVs are an awesome, fun structure of being able to say, how do we buy into secondary by kind of, keeping it in a separate side vehicle relative and away from our blended kind of principal venture fund, right? So I'm seeing SPVs as a function of secondary transactions all the time. I'm seeing various trust structures, like irrevocable trusts being set up, where it kind of falls under the transfer accepted provisions of a company, and then the shareholders are moving their shares into a trust, and they're doing this as a way to obviously optimize for taxes, and then bring in counterparties on that trust to act as a buyer in the transactions. I'm seeing concepts where shareholders are saying, you know what, I want to optimize for taxes. Maybe I don't want to theoretically sell my shares in a secondary transaction today, but maybe on paper have it be an event that happens a few years from now. So that's a way to optimize things like QSBS, qualified small business tax, and we can obviously get into any of that. But really, there are a variety of flavors that really can benefit a buyer and a seller in a secondary transaction, and making sure there's alignment on all of that kind of going into the whole secondary transaction is key. And that's, it takes some time, but doing it the right way can be very tax advantaged and efficient for those involved, or just as a way to make sure it's all kosher and the company says, hey, we understand who's involved here.
Yeah, I think structure tends to go away to some extent or be very simplified on the primaries when the market is up and to the right. And then when the market starts getting wonky and going down, structure gets worse. So at the primary level, I think a 1x liquidation preference, and I might be the series D for dog, but even the late seed and A guys are in the same 1x liquidation preference with us, meaning we all get paid out and that's it. Whereas it gets a little more structured that the series D investor gets their 100 million check back before the other guys get their 70 million back. That's a little structure. Or they could say, look, I know you're dying to raise flat round to raise more money at the summer 2021 valuation, but with the market crashing and you doing layoffs, we barely have the growth. Why don't we do this? I'll adhere to that, $1 billion pre-money valuation or the last post, but I get my money back 2x. So if I can get my money back 2x, I have a perceived zero risk of this. Not even Kevin Spacey can sink this thing. Then I have zero risk going in. I get a 2x. And hey, maybe you do grow into that $1 billion valuation that you never deserved. On the secondary, oh man, when we were doing the secondaries, you'd have like Palantir knew it was going up every 6 months. It's like every 6 months that thing was worth more. And they knew it. They just knew it on the inside. And so they'd say, I will sell you, $10 million worth of founder stock or early employee stock. And after you make a 2x on that, so after you get 20 million, I get the next 70% on the next 10 million and you get 30.
Yep.
And then after that, it flips so that you get 70 and I get 30. So the seller was having their cake and eating it too. They're like, all right, I'm willing to sell at a 10 billion valuation because I've got absolute conviction that we're going to be valued at 100 billion. Mm-hmm. So I'm going to let you think that you're ratchet screwing me when in fact, as soon as you've 2x'd and we're now at 20, I'm getting 70% of the next hit. And then I'll make you feel like you negotiated, my pants off with you get 70 and I get 30. So are you seeing creative structuring like that? Or is it just, let's keep it simple?
Oh, no, I would say, so you're kind of talking about the shared upside models where sometimes these take the form of a loan or some form of like equity coverage. It really depends on what that is, but shared upside lending in secondary transactions has, been since the dawn of time, a really awesome way to kind of measure that counterparty risk and the upside and what that's going to look like. We're definitely seeing all of that. I would say what's interesting that's playing out in today's market that everyone's thinking about is that you now have companies that hired employees during the COVID run-up of massive valuations.
So 409A valuation was high.
409A valuation was high, right? Which is the annual valuation set by companies by way of a third-party audit firm that's pricing the stock options of the company every year. What's happening is a lot of these companies hired employees during the run-up, and now because of the the volatility and valuations are coming down, you have employees who were issued stock options at a strike price that is higher than where the company's going to raise new primary capital money. And therefore, like if a secondary transaction was to occur, the offers that are being presented by investors are coming in at lower than the strike price of these stock options. And it's actually causing a massive discrepancy in these bid and ask spreads because employees are like, oh my God, I was issued stock at a $50 billion valuation. The company's now worth $20 billion. I'm completely out of the money on my stock options.
Yeah, so, no golden handcuff whatsoever.
None. And so, when you hear these headlines about startups lowering their valuations, this is key right now because quite frankly, it's a way to, kind of true up these employees who were otherwise, put out to pasture by way of the fact that their valuation and their strike on stock options was so high when they were first hired.
I'm curious to know if all these VCs are marking their TVPI and MOICs, their paper gains, down when the 409A comes. Normally, we methodology say we only mark up or down when we have a share price and a completed transaction has happened. But I think if 409A resets, you probably go with that as a markdown. It's so important. Well, listen, parting question, where are we in the bid ask? What do you see for the next 6 months to 12 months on primaries or the bid ask bit of, are VCs willing to raise money at a down round and interfere with their next fundraise or whatever their motive animal instincts are? Are founders willing to, or are these what are your thoughts? Companies that are sitting on 70 million in cash, just don't raise, just grow. Stop talking to investors.
Yeah, so I would say where I'm seeing just all of this on the bid ask and otherwise is the companies who were able to pull back on sales and marketing spend, pull back on G&A, pull back on product, are the ones who are becoming more capital efficient. And they're saying, hey, listen, during COVID, we had negative 30% margins across the board. We're now going to pull back on all that spend and increase capital efficiency and get to single digit negative margins, if not go above the line and actually be profitable on an EBITDA or cash flow basis. Those are companies who, if that narrative makes sense and they're still growing at a relatively strong annual year-over-year clip, those are the ones that I'm seeing are still being able to say, we're at least, worth the same valuation, and maybe they're doing a series extension of their last round. If at all they are doing up rounds, like there are still companies growing at really strong clips. They are still spending, they are still in the negative, but their overall growth is just so high that they can't slow that down. Those are raising up rounds. Like I am seeing that, but in many instances, the ones who just spent, they're cutting the head counts, they're going into single digit negative margins because that's probably the worst they could do while still maintaining growth. I mean, that's where the pullback on all of that is a little scary. And, raising, I will say, I mean, you probably agree with this, right? Like raising a series extension at a flat valuation is way better optics than raising even a minute down round. I mean, a down round signaling on that is just so scary to companies that they'll window dress it to the best they possibly can, whether it's warrants, whether it's, they'll tap into the debt facilities and figure out how to call it a flat round, if not an up round. And so digging into all the characteristics of that are so important for investors. Quite frankly, I'm still kind of expecting a couple quarters of seeing companies who raised the massive up rounds in 2021, they're coming back to the drawing board for a new round. And I'm going to still expect to see some pretty interesting either down rounds or funky variations around extensions playing out as a way to maintain the headlines.
Yeah, I think it's a tale of three cities. There's the set of companies that funders are chasing. There's always a funder chasing these companies. And maybe they benefit. Like we're investors in Easy Knock. The worse it gets, the better it gets for Easy Knock. And then there's the one that had like a business model of we give our customer $100 for 50 of revenue, and that music is just got to stop. And then there's the middle one of like, I have the same blog post or it's that I put out every time there's a market crash, and I say these are the changes you need to make in the next 30 days. And 30 days is like a real shock if you've just been a spending machine that just raises around every 9 to 12 months. It's hard to take a 30-day mindset of making those changes. So there's the ones that made those changes, and then there's those ones that crash into the side of the mountain, I think. But listen, Andrea, thank you so much for joining us today. I can't wait to have you on our panel, New York City, March 7th. And I'd be talking to you about selling some of our positions, but I don't want to sell anything right now in the current market. But final question, are you seeing anybody come to you just to price the damn company? Like, so you have insiders looking at doing an inside round or something, and they're like, well, MVP would be pretty expert in pricing it. I mean, that's maybe a good time for people to talk to you.
Yeah, all the time. We do a lot of price discovery across the board, which is pulling in a bunch of factors and variables in terms of what does the overall market look like for your stock and comps, whether they're private or public. And we do a lot of that exploratory stuff all the time. It's an awesome way for us to work with other investors and the companies themselves.
Okay. Andrea, thanks again. See you in New York in a couple of weeks.
Thanks so much, Andrew.
Okay, bye.
Well, that was certainly interesting. It's Mark DiTargiani with Pacific Western Bank back here. Again, really excited to be part of the podcast with 7BC and Andrew. And we're excited just to support the ecosystem and help you get to whatever your next step is in your business journey. Thank you very much.